We gave you fair warning. Our previous discussions highlighted a critical reality. Once banking institutions start losing their grip on silver pricing, they won't just sit idly by and permit the free market to take its course. We cautioned you that as short sellers approached the point of total collapse, the very infrastructure of the system would step in to provide them with a lifeline. We made it clear that if the powers that be realized they couldn't win under the current conditions, they would simply rewrite the regulations to suit their needs. Today, Tuesday, January 13th, 2026, those rules were officially rewritten. While the world was focused on the silver price attempting to break through the 86 per ounce ceiling, the Chicago Mercantile Exchange, the CME Group, released an urgent advisory. This document notice, number 26/0119, might seem like a dry, technical PDF to a casual observer, but for those who understand the inner workings of the market, it is nothing short of an open declaration of hostilities against the price of silver. Effective immediately, the CME is overhauling the methodology for determining margin requirements for precious metals. They are moving away from a fixed dollar figure and transitioning to a system based on a percentage of the total notional value. Specifically, they have pegged the silver margin requirement at 9%. To break this down into simple terms for the everyday investor, with silver hovering around the 85 mark, this adjustment essentially increases the financial burden of maintaining a silver contract by roughly 15%. The reason is that silver went into a vertical climb yesterday morning. The price jumped from $82 to $85 in a massive gap, eventually hitting a peak of $86 during the early electronic trading session. Large commercial banks holding massive short positions on millions of ounces of paper silver were suddenly looking at a total wipeout. They desperately required the buying pressure to halt. Their strategy was to purge leverage from the market by hiking margin costs. This forces every trader utilizing borrowed funds to make an immediate, difficult choice. Deposit $6,000 in fresh capital instantly, or watch as the exchange forcibly closes their position. This is a deliberate drain on liquidity, meticulously crafted to set off a chain reaction of forced liquidations. It is the exact same strategy utilized to stifle the silver market back in 2011, and again during the volatility of 2020. For a few fleeting moments this morning, it appeared as though their plan was working. If you examine the 30-minute chart we've been tracking, look at the sharp red candles appearing on the right side. The moment that margin update hit the news feeds, silver's price plummeted from $86 down to a bottom of $83.57. This wasn't a case of natural voluntary selling by investors. This was the mechanical reaction of algorithms to the new rules. It was the sound of leveraged speculators being kicked out of the game because they didn't have the table stakes required to keep playing. Predictably, mainstream financial outlets will interpret this dip as proof that the bull run has concluded. They will claim the market fever has finally broken. Their goal is to make you stare at that red candle and feel a sense of panic, hoping you'll dump your physical silver just because the paper-based price slipped by $2. However, before you succumb to fear, you must scrutinize the chart more closely. Look at the price action that followed the artificial crash. Back in 2011, when they implemented 5 margin hikes in a single week, silver's price was obliterated, losing 30% of its value in just a few days as it fell from $50 to $35. It was a total slaughter. Contrast that with today, they imposed a massive, punitive 15% margin hike, yet the price only slipped by $2.50. Now, look at the most recent candle on the screen. Notice the very long wick at the bottom. The price dipped to $83.57 and was met with an almost instantaneous wave of buying. As I record this, silver has already clawed its way back to $83.90. It flatly refused to stay down. This is arguably the most significant bullish indicator we have witnessed in this current cycle. The establishment deployed its most powerful financial weapon, making it significantly more expensive to hold silver positions in an attempt to crush the bull market MS momentum. And what was the result? A measly $2 dip that is already being absorbed. Why didn't we see a total collapse this time? The reason is that the individuals buying at $83 are not speculators using leverage. These are not people gambling on a chart. They are industrial consumers, sovereign wealth funds, and cash buyers. A buyer who pays in full with cash cannot be margin called. If a company like Samsung requires silver for its high-tech batteries, they couldn't care less about CME margin rules. They aren't playing with futures contracts for a quick profit. They are buying the actual metal for physical delivery. When the price dips to $83, they simply view it as a discount and buy more. The margin hike only penalizes the paper longs. It does nothing to deter the physical accumulators. In a strange twist, it actually assists the physical buyers by allowing them to snatch up metal at a lower price from the speculators who were forced out. This confirms our long-standing theory that the silver market has bifurcated into 2 distinct worlds. The paper market is being held hostage by arbitrary rule changes and margin adjustments, while the physical market is being propelled by genuine, undeniable scarcity. The banks are essentially trying to extinguish a massive forest fire using a small water pistol. They might be able to dampen the flames for a few minutes, but the underlying heat is far too powerful to contain. The margin hike, however, was just one of several signals of systemic alarm we noticed today. While the exchange was busy manipulating the rules, the U.S. government was reaching out for international assistance. Reports have surfaced that Treasury Secretary Scott Bessant held an emergency meeting with G7 finance ministers this morning. On the surface, the agenda was securing supply chains. In the world of high finance, when a Treasury Secretary calls a meeting about supply chains during a massive price spike, it's a euphemism. It means they have run out of material. It means the national strategic reserves are depleted. If the margin hike was the financial system's panic response, the news from Washington, D.C. represents the political panic. If you understand the subtext of these diplomatic statements, the political situation is actually far more alarming than the margin hikes. While the CME was trying to save the short-selling banks, the U.S. Treasury was attempting to stabilize the broader economy. We've confirmed that Secretary Bessant held an unscheduled, high-priority meeting with the finance heads of the G7, the economic NATO, that comprises the Western world's most influential financial powers. They didn't gather to discuss long-term policy or tax legislation. According to their official statement, the focus was on solutions to secure and diversify supply chains for critical minerals. To someone unfamiliar with this language, it sounds like standard bureaucratic chatter. But look at the timing and the context. Why was this meeting called precisely today, Tuesday, January 13th? It was called because silver reached $86 yesterday. It was called because the price gap in Shanghai exploded to $8. It was called because the global inventory of the most conductive metal on the planet effectively hit zero over the weekend. When a government talks about securing a supply chain, they are admitting the flow of goods has stopped. When they talk about diversifying, they are admitting they are dangerously over-reliant on unfriendly nations. Consider where silver originates. China is the world's third largest producer and its primary refiner. Russia is another major player. The BRICS nations essentially control the majority of the world's supply. The G7 ministers looked at their data this morning and saw the Shanghai market vacuuming metal out of Western vaults in London and New York. They saw a tidal wave of retail demand draining the U.S. Mint. They finally realized the West has no protection. The U.S. government liquidated its silver stockpile decades ago. We have no strategic reserve left. We depend entirely on a just-in-time global market that is currently failing. As we have discussed previously, the era of just-in-time delivery is over. We have entered the era of just-in-case hoarding, and the U.S. government has just realized it doesn't have the case. This meeting ties directly back to the military actions in Venezuela on January 3rd. While the media framed that as a move for democracy, we told you it was a desperate attempt to secure resources like oil. Now, 10 days later, we see that same desperation hitting the metals market. The establishment is realizing they cannot maintain a modern military, build a green energy grid, and support a digital economy without massive quantities of silver. Every modern weapon system, from Tomahawk missiles to F-35 jets, relies on silver because it is the world's best electrical conductor. If the supply chain breaks, which current dealer delays suggest is already happening, the entire defense industry stops. This is why the Treasury is involved. This is no longer just about the price of a silver coin. It is a matter of national security. The response is a coordinated pincer movement. The CME raises margins to crush the paper price and buy the government some time. Meanwhile, the Treasury assembles the G7 to try and form a buyer's cartel, attempting to lock down mining contracts in friendly nations like Mexico and Peru before China can claim them. The problem? China is already there. They have been signing long-term off-take agreements for years, while Western leaders were distracted by paper derivatives and social metrics. The G7 meeting is a confession of weakness. If they actually had the silver, they wouldn't need an emergency summit. The fact that this happened the very day the price spiked validates our entire thesis. $86 silver is not a speculative bubble. It's a symptom of a profound systemic deficit. Notice the shift in terminology. They are no longer calling it a precious metal. Now, it is a critical mineral. This rebranding is a calculated move. By labeling silver as critical, the government can now justify intervention. It allows for the use of the Defense Production Act and lets them prioritize industrial or military use over your right to buy it as an investment. They are setting the stage for rationing. If there's a choice between Samsung needing silver for batteries, Raytheon needing it for missiles, and you wanting it for your savings, you can guess who the government will pick. The G7 meeting is the first step toward a market where the public is intentionally excluded. They will make it harder for you to buy, increase premiums, and demonize hoarders so they can keep the metal for themselves. So when you see a $2 dip in the price due to a margin hike, don't feel defeated. The very people trying to suppress the price on the screen are the same people holding emergency meetings to figure out how to take the metal for themselves. The CME hike was a distraction. The G7 meeting is the reality. They know the bond market is failing, and now they know the commodity market is failing as well. They are fighting a losing battle against economic reality. Just as the margin hike failed to push the price below 83.50, the G7 meeting will fail to manifest new silver out of thin air. You cannot print a silver mine, and you cannot legislate a new ore deposit into existence. It takes a decade to bring a mine online. Secretary Bessant can hold all the meetings he wants, but unless he has the power of alchemy, he is out of options. In the next segment, we will explore the Shanghai shield. We will explain why the price difference with China is your best defense against Western manipulation. Even if the CME raises margins to 50%, it won't matter if Shanghai is still paying 93. The West is trying to bar the door, but the East has already torn the door off its hinges. The G7 is panicking, the CME is panicking. Are you prepared? This time is different because of the Shanghai shield. While New York tried to crash the price, the Shanghai Gold Exchange closed at over $93. That is a $10 gap. In 2011, the global market was unified, so a sell-off in New York affected everyone. Today, the market is fractured. The West is trading paper, while the East is trading physical metal. Because the East is paying $93, the Western price has a hard floor near 83. If the CME tried to push the price to $70, it wouldn't kill the bull market. It would supercharge it. The arbitrage opportunity would be so massive that every trader on the planet would buy the cheap New York silver and ship it to China for a 23 per ounce profit. The COMEX would be drained of every ounce of silver it has within 48 hours. The banks are in a checkmate position. If they crash the paper price, they lose their physical metal to China. If they let the price rise, they go bankrupt on their shorts. The data proves they are already losing the metal. While the price was dipping on the screen today, the actual vaults were being raided. Today's depository statistics are a sea of red. Over 2.2 million ounces of silver were pulled out of the COMEX system in a single day from various major vaults like Brinks and StoneX. Most importantly, the registered category, silver available for immediate sale, has plummeted to just 123 million ounces. The margin hike didn't stop the outflow. It actually helped the entities draining the vaults by putting silver on sale. Capital is fluid, and it is flowing to Shanghai where it is valued higher. You should not fear the volatility because the Chinese bid has created a concrete floor under the market. We are seeing the total balkanization of silver pricing. For a century, New York dictated the terms. Now, Shanghai sets the floor. The paper tools of manipulation, margins, spoofing, wash trading, only work when the physical market is dormant. But the physical market is wide awake, and it is consuming the COMEX. Those 2.2 million ounces that left today are gone forever, destined for industrial use. If the establishment can't stop the price with paper or policy, their only remaining move is to close the exit doors for the public. We are already seeing the retail lockout. Major retailers like Costco are now implementing strict purchase limits. Why limit sales of a popular product unless you're terrified of running out and being unable to restock? This is soft rationing. Even the U.S. Mint is struggling. They released the 2026 Silver Eagles this morning, and they sold out instantly, leading to a 1-month backorder notice. The government cannot even produce a simple coin fast enough to keep up. Meanwhile, the futures market is showing backwardation, where traders are fighting to stay in the current delivery month, because they don't trust the metal will be there in the future. This is a classic short squeeze. The system is blinking red. They tried to break your spirit today with a margin hike and a red candle, but the market refused to break. The $83.90 price is a flag of victory for the physical buyers. The path to $100 is wide open because the resistance at $80 and $85 has been tested and surpassed. The next stop is the Shanghai price of $93. The Empire tried to strike back today, but it missed its mark. Would you like me to analyze the specific Shanghai Gold Exchange volume data from this morning to see if the arbitrage gap is widening further?